Welcome to our deep dive right into the middle of Nepal's insurance world.
Oh, yeah.
You're here to learn about how insurers there are figuring out and
Yes.
managing risk, and
Right.
we've got some interesting stuff to share.
Yeah, it's a really fascinating time for Nepal's insurance industry.
Yeah.
They're really moving beyond just, kind of ticking boxes for compliance and taking a much more kind of proactive approach to risk.
Right, so we're looking at two key documents.
Okay.
The Risk-Based Capital and Solvency Directive, 2022,
Okay.
and the Own Risk Solvency Assessment, or RSA, toolkit.
All right.
Now, those titles might sound a little technical, but trust me, these documents reveal
Right.
how Nepal is adopting these cutting-edge global practices to build a more resilient insurance sector.
Yeah, that's right. These documents show a real commitment to
Okay.
not just reacting to past events, but actually kind of anticipating those future challenges,
Oh, wow.
especially with emerging risks like climate change becoming so important.
Yeah, that's where it gets really interesting.
Yeah.
So let's start with the foundation, the concept of risk-based capital.
Okay.
Can you break down what that means and how it plays out in Nepal's 2022 directive?
Sure. So the basic idea behind risk-based capital, or RBC, is that an insurer's required capital
Right.
isn't just some fixed number.
Okay,
It's directly tied to the level of risk they're taking on.
I see.
So an insurer with a portfolio full of like volatile tech stocks
Mm-hmm.
will need a much larger capital cushion than one,
Okay.
primarily holding stable government bonds.
Interesting.
Yeah, the riskier your business,
Mhm.
the more capital you need to hold.
Okay, so it's all about making
Yeah.
sure that the capital requirements are aligned with
Yes.
the actual risks being taken,
Exactly.
which makes total sense.
Yeah.
And the directive actually outlines
Wow.
several types of risks.
Yes, it covers a wide range, including
Right.
credit risk, market risk,
Oh.
insurance risk, and operational risk, each of which require a tailored approach to assessment and management.
Now, this leads to a really crucial question. How does an insurer actually figure out how risky their business is?
Right.
This is where the ORSA toolkit comes in.
Got it.
Okay.
The ORSA toolkit provides guidance on conducting an own risk insolvency assessment,
Mm-hmm.
which is essentially a comprehensive risk checkup for the insurer.
So it's like an insurer holding up a mirror and getting real about their risk profile.
Exactly.
So I love that.
Yeah.
And the toolkit not only helps insurers meet those basic
Yeah.
regulatory requirements, but also empowers them to set their own internal targets,
Exactly.
which might even exceed those minimums.
They're encouraged to go above and beyond just ticking boxes.
Okay.
It's about understanding their unique risk profile
Mm-hmm.
and taking ownership of their risk management.
That's quite a shift in mindset.
It is.
It reminds me of setting personal financial goals that are even more ambitious than what your financial advisor might suggest.
Right.
You know, you're taking control and aiming higher,
Exactly.
but how do they actually measure these different types of risk?
Okay.
It seems like it could get
Break
pretty
them down.
complex.
So it can be complex,
Okay.
but the toolkit emphasizes starting with understandable steps.
Okay.
For example, how do you predict how many life insurance claims
Mhm.
might arise from a future pandemic
Oh, wow.
or the impact of climate change on your investments?
Those are some big questions.
Yeah.
I can see why insurers need robust tools and frameworks to tackle these challenges.
Right.
I'm really curious to dig into the specifics of how they measure these risks.
Well, before we jump into those details,
Okay.
it's important to understand that risk management isn't just
Okay.
about complex models and calculations.
Yeah, okay.
It starts with a fundamental shift
Mm-hmm.
in the way insurers think about risk.
Okay.
And that's where ORSA plays a crucial role.
That makes a lot of sense.
Yeah.
It's about building
Mm.
a risk-aware culture
Right.
throughout the entire organization, right?
Yeah, from the boardroom to the front lines.
Yeah.
Everyone needs to be on the same page.
This is already giving me a much clearer picture
Yeah.
of how Nepal's insurance industry is approaching risk.
Okay.
I can't wait to dive into the specifics
Yeah.
of how they measure and manage
Right.
these different risk categories.
That's what we'll be exploring in the next part of our deep dive.
Okay.
We'll break down those specific risk categories outlined in the directive.
All right.
And see how ORSA helps insurers go beyond just meeting the minimum standards.
Sounds fascinating.
Okay.
I'm ready to unpack those details further.
Yeah.
Welcome back to our deep dive into Nepal's insurance scene.
Yeah.
In the last part, we explored the concept of risk-based capital
Right.
and how it ties into Nepal's 2022 directive.
Mm-hmm.
Now, I'm really excited to unpack how insurers actually measure and manage all those different types of risk.
It's definitely a fascinating area.
Yeah.
Let's start by diving into the specific risk categories
Okay.
outlined in the directive, starting with credit risk.
Okay.
This is all about making sure the entities an insurer does business with, like borrowers or reinsurers,
Right.
are financially sound.
So if an insurer is holding bonds issued by a company with a shaky credit rating,
Right.
that would be a red flag in terms of credit risk.
Exactly.
Okay.
The directive actually uses a tiered approach,
Okay.
assigning different risk factors based on those credit ratings.
I see.
High-quality investments with top-notch credit ratings have lower risk factors,
Okay.
while those with lower ratings carry higher risk factors.
Interesting.
It's a way of calibrating the capital requirements to the perceived riskiness of the investment.
That makes sense.
Yeah.
It's like a sliding scale where higher risk equals a higher capital charge.
Right.
The directive also addresses the concept of concentration risk, right?
Yeah.
What's that all about?
Concentration risk is about avoiding putting all your eggs in one basket.
Okay.
It's the danger of having too much exposure to a
Ah.
single counterparty industry or asset class.
Right.
If that one entity or sector takes a hit,
Yeah.
the insurer could be in trouble.
Ah. So diversification is key not just in investing,
Yeah.
but also in managing credit risk.
Exactly.
It reminds me of that old saying, don't bet the farm on one horse.
Right.
The directive actually gets pretty specific
Yeah.
about mitigating concentration risk.
It
right?
does. It doubles the default risk factors
Wow.
for the 10 largest investments an insurer holds.
Interesting.
That's a pretty strong signal that spreading your risk is crucial.
Smart move.
Yeah.
Now let's shift gears and talk about market risk.
Okay.
This one seems a bit more abstract to me.
Right.
How does the directive define it?
Market risk is all about those unpredictable swings
Okay.
in the financial markets.
Mm-hmm.
Things like interest rates, equity prices,
Yeah.
exchange rates, even property values.
Right.
These fluctuations can directly impact
Yeah.
the value of an insurer's investments
Yeah.
and even the profitability of their insurance products.
So it's about navigating the ups and downs of the market
Right.
and making sure those swings don't wipe out an insurer's capital.
Exactly.
The directive actually breaks market risk down into several subcategories, right?
Yes, it does.
Okay.
It specifically looks at interest rate risk,
Mm-hmm.
equity risk,
Okay.
exchange rate risk, and property risk.
Okay. Let's take them one by one.
Sure.
So let's start with interest rate risk.
Right.
This seems especially relevant for life insurers since they often have those long-term liabilities, right?
That's a great point.
Okay.
Interest rate risk is a major concern for life insurers.
Right.
The directive lays out a method for calculating
Okay.
the interest rate risk charge,
Mm-hmm.
which involves modeling the impact
Yeah.
of both increases and decreases in interest rates
Right.
on the value of an insurer's assets and liabilities.
So they're running simulations to see how different interest rate scenarios would play out.
Yeah, they use the biggest deviation from the base scenario
Oh.
to determine the capital charge.
Interesting.
It's about preparing for the worst case scenario
Right.
and making sure there's enough capital to weather the storm.
Makes sense. Now, what about equity risk?
Okay.
This seems more relevant for insurers
Right.
with significant investments in the stock market.
Yeah.
How does the directive handle that?
The directive tackles equity risk by applying specific risk factors
Okay.
to different types of equity investments.
I see.
For example, ordinary shares of publicly listed companies,
Mm-hmm.
the kind you'd typically find in a stock portfolio,
Right.
are assigned a lower risk factor than unlisted shares.
Okay.
That's because publicly traded stocks tend to be more liquid and transparent.
So it's recognizing that not all stocks are created equal in terms of risk.
Exactly.
Some are inherently riskier than others.
Right. And again, this approach ties back to that core principle of
Right.
risk-based capital.
Yeah.
The goal is to align the capital requirements with the actual risks being taken.
Okay, we've covered interest rate risk and equity risk.
Right.
What about exchange rate risk?
Okay.
This seems particularly relevant for Nepal,
Yeah.
given its reliance on foreign trade and investment.
You're absolutely right.
Okay.
Exchange rate risk is all about the potential for losses
Yeah,
due to those fluctuations in currency exchange rates.
I see.
It's definitely a concern for insurers
Mm-hmm.
with assets or liabilities
Yeah.
denominated in foreign currencies.
It seems pretty intuitive. If an insurer has more assets than liabilities in a particular currency,
Yeah.
They'd be exposed to the risk of that currency depreciating.
Yes. The directive sets a specific risk factor for exchange rate risk,
Okay.
and it's applied to the net open position
Right.
in each foreign currency.
This encourages insurers to carefully manage their foreign currencies exposures, maybe through hedging
Right.
or by matching assets and liabilities in the same currency.
Right. Now, the last subcategory of market risk we need to cover is property risk.
Property risks so much can impact property values,
Right.
economic downturns, natural disasters, even changes in those local zoning regulations.
Mm-hmm.
How does the directive address this?
The directive actually makes a distinction between properties held for investment purposes.
Mm-hmm.
Think of those as more like financial assets.
Right.
And properties used for the insurer's operations,
Okay.
like their office buildings.
I see.
It applies different risk factors to each category,
Okay.
recognizing that investment properties are generally more sensitive to those market fluctuations.
So they're acknowledging that a commercial office building might be a steadier bet than, say, a speculative real estate investment in a booming market.
Exactly.
That makes a lot of sense.
It does.
And it highlights the importance of carefully considering the risks associated with those different types of property investments.
Right.
We've covered a lot of ground on market risk.
Okay.
Let's move on to what's probably the most crucial category for an insurance company, insurance risk.
Right.
This seems like the heart of their business.
You're absolutely right.
Yeah.
Insurance risk is the risk that the claims and expenses an insurer actually has to pay out will exceed the premiums they've collected.
It all comes down to accurately pricing your insurance products and making sure you have enough reserves to cover potential claims.
Right. And the directive approaches this differently.
Okay.
For life insurance and non-life insurance, recognizing that the nature of those risks is quite different.
Let's start with life insurance.
Okay.
I'm curious how the directive tackles that.
For life insurance, the directive requires insurers to perform specific stress tests to assess their capital adequacy.
I see.
These tests involve shocking key assumptions, things like mortality rates, morbidity rates, lapse rates, and even expenses to see how those changes would impact the insurer's financial position.
So it's like putting those life insurance models through a pressure test to identify any potential weak points.
Exactly. It is the results of those stress tests are then used to determine the capital charge for life insurance risk.
Right.
It's all about making sure those life insurers have enough capital to withstand even those severe adverse scenarios.
That definitely provides a safety net for policyholders, which is reassuring. Now, how about non-life insurance risk? Is that assessed?
For non-life insurance, the directive uses a combination of factors to calculate the capital charge, the insurer's outstanding claims, earned premiums, and their exposure to catastrophic risks like earthquakes.
It's a more holistic view, considering both current claims experience and the potential for those large-scale losses down the line.
Right. The directive also assigns specific risk factors for different classes of non-life insurance business, recognizing that some types of insurance are inherently riskier than others.
Absolutely. For example, motor insurance usually has a higher risk factor than, say, fire insurance.
Right.
Because car accidents tend to happen more frequently and can be more costly.
Exactly.
This really highlights how much thought goes into setting those risk factors.
It does.
They're not just arbitrary numbers. They reflect a deep understanding of the underlying risks and historical data.
Exactly. And that's a key principle of risk-based capital. Making sure those capital requirements are aligned with the actual risks being undertaken.
Now, we've covered credit risk, market risk, and insurance risk. Those seem like the big three. But there's one more category we need to explore, operational risk. This one seems a bit different.
It is.
Yeah.
Operational risk isn't about financial markets or insurance products directly. It's about those internal failures or external events that can disrupt an insurer's operations.
I see.
Talking things like fraud, IT system failures, natural disasters, even pandemics.
It feels like a really broad category, almost like a catch-all for anything that could throw a wrench in the gears. How does the directive approach this?
Recognizing that operational risks can be tough to measure and model precisely. The directive takes a somewhat simplified approach. The capital charge is based on a percentage of the insurer's gross written premiums
I see.
with a cap and a floor to limit the volatility of the charge.
So it's a more standardized approach,
Yes.
acknowledging that predicting and quantifying operational risks is trickier than those other risk types?
Exactly. But the directive also really emphasizes the importance of robust risk management practices to mitigate those operational risks.
So things like strong internal controls, business continuity plans, and effective risk mitigation strategies.
Exactly.
Right? It's about having those safeguards in place to prevent those operational hiccups from turning into major disasters.
Right.
We've covered all four main risk categories now.
Right.
Credit risk, market risk, insurance risk, and operational risk.
Right.
It's impressive how thorough this framework is.
It is.
It really provides a structured way to understand and manage those diverse risks.
It really does, and it lays a solid foundation for a risk-aware insurance industry in Nepal.
Now, we've talked a lot about the directive,
Right.
but I'm curious how this all connects back to the ORSA process we discussed earlier. They seem complementary, but it's not immediately clear how they fit together.
That's a great question, and it's something we'll delve into in the final part of our deep dive. We'll explore how the ORSA process actually builds upon the foundation established by the directive, encouraging insurers to go beyond simply meeting those minimum standards.
I can't wait to unpack that. It sounds like ORSA takes risk management to a whole new level.
It does.
Welcome back. We've spent the last two parts going over the risk-based capital and solvency directive, and exploring, how it shapes Nepal's approach to managing those various risks. Now it's time to tie it all together with the Own Risk Solvency Assessment process, or ORSA for short. Remind us why this ORSA toolkit is such a game changer.
So ORSA is about encouraging a real shift in mindset. It's not just about checking boxes to comply with regulation. It's about pushing insurers to develop a deep understanding of their own unique risk profile.
So less about reacting to what's already happened and more about proactively anticipating what could happen down the road.
Precisely. The toolkit provides a framework for identifying, measuring, monitoring, managing, and reporting on all those material risks an insurer might face.
So it's not enough to just have a fancy risk model sitting on a shelf somewhere. It needs to be integrated into the day-to-day operations.
And that means using this risk information to make informed decisions about everything from underwriting and pricing to investment strategies and even capital allocation.
It sounds like a continuous process of adapting and evolving.
It is. The toolkit recognizes that risks are constantly changing. So the ORSA process can't be a static one-time exercise. It needs to be dynamic and adaptable.
It's about building a risk-aware culture that permeates the entire organization.
Now, connecting this back to the directive we've been discussing, we can see a clear progression. The directive sets those foundational standards with its risk-based capital framework. Then ORSA steps in and encourages insurers to go beyond just meeting those minimums.
The directive sets the baseline, and then ORSA challenges insurers to raise the bar even higher. It gives them the tools to set those more ambitious internal targets.
And that synergy between the regulatory requirements, those internal risk management practices, is key for building a truly resilient insurance sector.
Now, I'm curious how the ORSA toolkit addresses those ESG risks touched on earlier, those environmental, social, and governance factors that are becoming increasingly important.
The toolkit emphasizes the importance of integrating ESG considerations into every stage of the ORSA process. Insurers are encouraged to think about how factors like climate change, social inequalities, and even corporate governance issues could impact their business now and in the future.
So let's say an insurer is considering investing in a company with a questionable environmental record. They need to factor that into their risk assessment through the ORSA lens.
Absolutely. And the toolkit goes beyond just identifying those risks. It encourages insurers to come up with strategies for managing them. This could involve excluding certain investments, working with companies to improve their ESG performance, or even developing new insurance products that encourage more sustainable practices.
ORSA is pushing the industry to consider a much broader range of factors than ever before.
You're right. It's not just about financial stability anymore.
That's a powerful shift in perspective now before we wrap up.
Okay.
I want to circle back to the role of the regulator. We mentioned earlier that Bima Samiti, Nepal's insurance regulator, has a supervisory ladder related to ORSA. Can you unpack that a bit more?
Certainly the supervisory ladder outlines a series of actions that Bima Samiti can take. If an insurer isn't implementing ORSA effectively, or if their risk management practices are deemed inadequate.
So it's not a one-strike-and-you're-out system.
Right.
It's about providing guidance and support to those insurers and then escalating just stronger measures if needed.
The toolkit outlines some pretty serious interventions that the regulator can take. Things like requiring additional capital or even withdrawing an insurer's license in extreme cases.
It sounds like Bima Samiti is taking a balanced approach. They're encouraging self-assessment and proactive risk management, but also ensuring that those standards are upheld.
It's all about finding that sweet spot. Empowering insurers to take ownership of their risk management while also safeguarding policyholders and ensuring the stability of the entire insurance industry.
Well, we've come full circle on this deep dive.
We have.
We started with the regulatory framework outlined in the Risk-Based Capital and Solvency Directive.
And explored how ORSA takes those principles to the next level, fostering a much more sophisticated approach to risk management.
It's been quite a journey.
It has.
And it really underscores the dynamic nature of risk management in this industry as new risks emerge, both within Nepal and globally. Both insurers and regulators need to constantly adapt and evolve their approaches.
I think we've equipped you with a great foundation for understanding.
I hope so.
How Nepal's insurance industry is navigating the complexities of risk.
But
the learning doesn't stop here.
No.
We encourage you to delve into those source documents we discussed. And consider how these principles might apply in your own context.
And remember, risk is an inherent part of life. And especially in the world of insurance. But by understanding those risks and managing them thoughtfully, we can create a more resilient future for everyone.
Well said. Thanks for joining us on this deep dive, and we'll see you next time.